Hello friends, I'm back making a video after a long time. As the name suggests, this video is about how my journey being an equity investor has been over the years and how I reached my 1 million rupees portfolio, not dollars. I know it's not that much, but yeah, there have been a lot of learnings during this phase, and I want to share those insights with you guys so as to contribute something of knowledge, of my knowledge. So first of all, I want to start off with the history of my investments, like how I have been investing over the years. Initially, I have invested in mutual funds, fixed deposits. I have made a considerable amount of investment in real estate, and then I started gradually investing in the equity market as I grasped a greater understanding of the equity market. At the start of the year, my portfolio size was around 4 lakhs. Since then, I have been tracking my investments properly in a proper manner, as I would say. And over a period of 7 months, it has reached the 1 million mark through reinvestments, through more investments and reinvestment of my profits that I have booked over various stocks. So this during this journey, I have learned a lot. I would like to share my learnings with you over a series of videos. Today I'll be starting with the concepts of how to invest, where to invest, and what your targets should be. The first of all that needs to be considered is the duration for which you are willing to spend your investments on. So, is it a short term? That meaning that it is short term requirements, meaning it is for less than 1 year period, or is it for a long term investment? You are thinking of investing till your retirement. So, this kind of thing should be clear in your mind. Will you be investing regularly or a lump sum amount like 10,000 SIP in equity over a long time, or a lump sum investment of 50,000 once in a particular stock. So the time horizon should be clear to you, like you will be needing that money for in another 2 years, 3 years, like that. Because as you guys all know, that equity is a liquid kind of investment, unlike real estate or bond investments where your money gets locked in for a considerable amount of time. With equity, you can sell off your stocks anytime and book that profit, be it through direct equity or through mutual funds. So that is an advantage of equity. With advantage also there are risks. Now, obviously, and risks related to the investments in the stock market, so that has to be considered as well. So the next thing is that what should your target be investment. So the main primary target should be for your investments should be to beat the inflation of the economy. So it is a macroeconomic point of view that money always grows. So what you are getting to buy for 100 rupees today won't be the same amount. It will be requiring more amount of money to buy the same items in the next 10 year, after a 10-year period of time. So you have to beat the inflation with your investments. So you have to you have to consider the average inflation rate of 6 to 8% in India, and you have to beat that inflation rate accordingly for your investment. So there are various kinds of asset classes for making your investments. Like I said, real estate and your debt instruments are there, which are for the longer period of time locked in. So the most primary is the savings account, which will give you a 2 to 3% annual rate of return. So that if you don't do anything, if you keep your money in the banks, that is the what you will get after 1 year. The next comes your debt funds, like the fixed deposits. The fixed deposits yield around 6% to 7% based on the interest rates by the RBI. So will be that also varies over the period of time, which also comes with the tax burden on your profits. That is another way. Then there is the PF, which is provided by the government, which also has a considerable amount of lock-in period. That is current rate of 8.25%. So you will be making money at 8.25%, which is better than the 6% inflation rate. Now moving on to the equity market. So through mutual funds, there are various fund managers who are giving 14%, 15%, 16% CAGR, that is compounded annual growth rate. So those are promising mutual funds. You can go through those mutual funds and invest over there. The key benchmark for investment in the stock market should be the returns from the Nifty 50 index, which is considerably a safer bet, because Nifty 50 constitutes the 50 largest companies of the country. So there are index funds who invest in the Nifty 50 market itself, which are called the index funds. So over the period of time since its inception, the annual rate of return from Nifty 50 has been around 13%, which is quite good over a prolonged period of time. So when you are investing in the equity market, your primary goal should be beating the Nifty 50. Otherwise, it's better to go with the Nifty 50, because you have to invest considerable amount of time for your investment in the equity market. You have to invest your time, you have to track your investments, you have to monitor your investments. All these are added burdens when you are doing your investments manually by yourself. So you should be able to reap a return higher than 13% if you're investing in the equity market. So is greater than 13% sufficient? The outright answer should be no. Reason being the tax burden that you will be incurring on your profits that you make from your equity market profit investments. So according to the current budget, the short-term capital gains tax is 20%. So suppose you are investing 1 lakh rupees in the market today, and after 8 months you make a profit of 15% from a stock, and you sell it off and you book your profit. So you're getting 15,000 from your investments of 1 lakh. But because it is a short term capital gain, you have to pay 20% tax, which is coming to 3,000 rupees. So the net gain that you will be having from this investment is only 12,000, which is equivalent to 12%. So even a 15% profit won't beat the long term capital gains from index fund investment. So you have to consider all these things. For long term capital gain, tax is 12.5%, which is considerably better. So if you're keeping your money for more than 1 year, then you will be attracting a tax of 12.5% on your profits. So all these things should be considered before making the investments. So this should be the targets. Now the next part of the video I'll be making about how I go about selecting stocks. So for this is all for today.